Welcome. This presentation is a practical introduction to the foundations of financial security. It is based on the How Money Works Financial Education Guide, and its central message is straightforward. Progress usually comes from ordinary decisions repeated consistently over time. Financial independence can seem reserved for people with exceptional incomes, family wealth, or perfect timing. The guide challenges that assumption. It argues that you do not need a windfall to begin moving in a healthier direction. What matters first is clarity, knowing what you can control, choosing a plan, and building systems that make good financial behavior easier to repeat. During the next 30 minutes, we will move through a connected set of ideas. We will begin with spending, saving, borrowing, and planning. We will look at why saving first can be more reliable than saving what happens to remain. We will see how debt compounds, how time can support small investments, and why protection, tax awareness, ownership, diversification, and consistent investing all matter. This is general education, not a promise of a particular result or a recommendation to buy a specific financial product. Your own income, debts, family responsibilities, taxes, health, insurance needs, risk tolerance, and local rules are important. For decisions affecting your circumstances, consult appropriately qualified professionals. But the framework is widely useful. Understand trade-offs, make money intentional, and begin before you feel perfectly ready. As you watch, do not try to redesign your entire financial life at once. Listen for one or two actions that would make the greatest difference if you took them this month. Financial security is rarely built by one dramatic victory. It is built by small decisions that compound.
Financial security begins with an important distinction. The future contains many forces you cannot control, but that does not make you powerless. Interest rates change, prices rise, markets fall, employers reorganize, government programs evolve. No personal finance plan can remove uncertainty. What you can control is meaningful. You can decide how much of your income you keep. You can examine recurring expenses. You can reduce costly debt. You can work to increase income. You can build a reserve. You can learn the rules of the accounts available to you. And you can avoid placing your entire future on one investment, one employer, or one uncertain event. The source guide highlights the difference between a need and a want. A need protects health, safety, shelter, or basic functioning. A want is desirable, but not essential. Wants are not bad. The purpose is simply to make spending a conscious choice. When every purchase is automatic, spending quietly directs your future. When you pause and decide, your goals begin to direct it instead. Try this exercise. Write down 3 financial goals. 1 near-term, 1 medium-term, and 1 long-term. Give each goal a number, a target date, and a reason that matters personally. A near-term goal might be ending credit card debt or building an emergency fund. A medium-term goal may be a down payment, education, or a planned career change. A long-term goal may be retirement flexibility or the ability to help your family. Once a goal is specific, everyday choices become easier to judge. You are not only deciding whether to buy something, you are deciding whether that purchase moves you closer to or farther from something you value more. The first step in a financial plan is not predicting the future. It is choosing the direction you want your money to support.
Most people agree that saving is important. The difficulty is often the sequence. If you wait until every bill, purchase, subscription, surprise expense, and impulse buy has been handled, there may be little left.
The guide proposes reversing that order. When income arrives, set aside a planned amount for your future before the rest is absorbed by current spending. The source uses 10% of income as a memorable benchmark. That can be a useful target, but the larger lesson is the habit. If 10% is unrealistic today, start with an amount that is. It could be 1%, 5%, or a fixed amount. The point is to prove that saving is not an afterthought. It is a commitment to your future self and your family. Automation makes the habit more dependable. Motivation changes from month to month. Systems do not rely on feeling motivated. If your bank or employer allows scheduled transfers, direct the saving amount into the correct account soon after payday. If your income varies, consider a percentage-based rule instead of one fixed amount. Higher income creates a larger contribution. Lower income still protects the habit. Paying yourself first does not mean ignoring high-interest debt, essential bills, or a real emergency. It means treating future security as a legitimate obligation. For someone with costly revolving debt, the first saving goal may be a small emergency buffer that prevents new borrowing, followed by faster debt repayment. For someone with stable debt, the next goal may be regular long-term investing. A useful baseline is to estimate the percentage of your income that has actually been saved or invested so far. This is not a reason for guilt. It is simply a starting point. Once you know the baseline, improvement becomes visible. A small automatic transfer can look modest today, but it becomes powerful when it turns into a lasting pattern.
Paying yourself first is more effective when the money has a clear job. The guide describes 3 basic categories: an emergency account, a short-term account, and a wealth-building account. Think of them as separate buckets rather than one vague pool of savings. Each bucket has a different timeline, purpose, and level of risk that may be appropriate. The emergency account protects the rest of your plan when life becomes unpredictable. A car repair, uncovered medical cost, urgent travel need, appliance failure, or income interruption should not automatically become new credit card debt. The guide uses at least 3 months of income as a target. Your own target may need to differ depending on job stability, household size, dependents, health, insurance, and access to other support. The key is accessibility and discipline. Emergency money is for disruption, not routine spending. The short-term account covers known or likely needs in roughly the next 3 to 5 years. Examples include a home down payment, tuition, a vehicle replacement, a major repair, or a reserve for a career transition. This money often needs less volatility because it may be needed on a schedule. A market decline just before a planned purchase can be especially damaging when you do not have time to wait for recovery. The third bucket is wealth-building money. This may support retirement, long-term healthcare needs, family legacy, or other ambitions years or decades away. A longer time horizon may provide more capacity to endure short-term fluctuations in pursuit of long-term growth potential. But potential is never a guarantee, and the right balance depends on your circumstances. This framework changes the question from where should I put my money to what must this money do and when will I need it. The same investment can be suitable for one goal and unsuitable for another. Give every dollar a job, match the tool to the timeline, and avoid forcing long-term investments to solve short-term emergencies.
Debt is not only a balance, it is a process. When borrowing costs are high and payments are small, compound interest can make a manageable purchase become an expensive, long-lasting obligation. The guide illustrates this with a one-time $3,000 credit card purchase at a 20% interest rate.
Paid only with the minimum required payments, it can take at least 10 years to eliminate and can generate more than $2,350 in interest. The exact result depends on card terms, but the lesson is clear. Minimum payments can keep a balance alive for a very long time. The guide distinguishes revolving debt from fixed debt. With a credit card balance, payments may decline as the balance falls, while interest continues compounding on the remainder. With a fixed repayment schedule, the payment and payoff date are clearer. The goal is to know what you owe, what it costs, and when you will be free of it if you follow the plan. One structured approach is debt stacking. List every debt, its balance, interest rate, minimum payment, due date, and material terms. Keep required payments current on all accounts. Then direct every available extra dollar to one target debt. The target may be selected according to interest cost, balance size, psychological momentum, or a plan from a qualified debt professional. When one balance is gone, add its former payment to the next target. Your total monthly debt effort stays constant, but more of it reaches principal. The Source Guide's example shows how this rolling payment approach can greatly shorten a payoff schedule without increasing total monthly debt payments. Progress accelerates because each eliminated payment becomes fuel for the next balance. Debt consolidation can sometimes simplify payments or lower interest, but it requires care. A lower monthly payment does not always mean a lower total cost. Compare fees, term length, collateral, and the risk of rebuilding credit card balances. If debt feels unmanageable, seek reputable, independent help early. The key move is to turn debt from a vague source of stress into a finite written plan with a visible debt freedom date.
Once costly debt is under control, the same force that made debt expensive can begin working in your favor: compounding. Compounding means that returns earned on your money may themselves earn returns. In the early years, growth can appear slow because the starting balance is small. Over longer periods, earnings are calculated on a larger and larger base. The rule of 72 is a useful mental shortcut. Divide 72 by a hypothetical annual rate of return, and the result estimates the years it would take for money to double at that rate. At 3%, the estimate is about 24 years. At 6%, it is about 12 years. At 12%, it is about 6 years. This is not a forecast. Real investments fluctuate, fees and taxes matter, and losses are possible. But the rule makes one idea visible. Small differences in time and return can create very different outcomes. The Source Guide uses a hypothetical $1,000 investment at birth, growing at a constant 9% to about $339,000 at age 65. That number is not a promise. It is a mathematical demonstration of why time is an asset. A person who starts earlier can often contribute less each month than someone who starts later and still give money more years to work. Consistency is time's companion. Most households do not invest a large lump sum and forget about it. More often, progress comes from modest, regular contributions. The guide compares $20 a month with $100 a month over 40 years at a hypothetical 9%. The difference becomes substantial because the higher contribution is repeated and every contribution has time to compound. If you cannot begin at $100, begin at $20. If you cannot begin at $20, choose a smaller automatic amount. The habit matters more than the initial number. Waiting has a price. The monthly saving required to reach a long-term goal rises sharply when the start date is delayed. You cannot invest in an earlier decade, but you can make today the earliest available start. Use the rule of 72 as a reminder. Time, consistency, and return
reinforce one another.
A complete financial plan does more than pursue growth. It also protects against events that could derail the plan. The guide frames life insurance primarily as income protection. If a person's income, caregiving, or other contribution is essential to a household, the premature loss of that person can create both emotional and financial hardship. Appropriate coverage can help a family maintain stability while it adjusts. The useful questions are not only how much coverage can I buy? Ask who depends on your income or caregiving. What debts or future obligations would remain? How long the household would need support? What other resources exist? And how needs may change as children become independent, debt declines, assets grow, or retirement approaches. The guide describes decreasing responsibility. In earlier years, a household may have young children, high debt, and limited savings. The need for income replacement can be significant. Later, children may be independent, debt may be lower, and accumulated assets may take on a larger role. Coverage should be reviewed as circumstances change rather than treated as a one-time decision. The source strongly presents term life insurance as economical temporary protection and argues for separating insurance from saving and investing. That is an educational viewpoint in the guide, not a universal rule for every person. Cash value, whole life, and universal life policies can have different features, costs, guarantees, limitations, tax treatments, and suitability considerations. Before buying, changing, or canceling coverage, obtain full policy information and compare advice from a properly licensed insurance professional who understands your circumstances. The broader principle is durable. Do not let complexity hide the job a product is meant to do. Evaluate insurance for protection. Evaluate investments for growth potential, risk, fees, access to money, and fit with goals. Separating the functions makes it easier to ask better questions. Protect the people and obligations that matter. Then build wealth with tools designed for long-term wealth building. Taxes are part of the financial system, not an afterthought. The source guide is written for a Canadian audience and highlights registered accounts that can help people save in a tax-deferred or tax-free way. Rules, limits, eligibility, and withdrawal consequences change, so the goal is not to memorize a number. The goal is to understand why the tax container matters. Tax deferral means that tax on investment growth is postponed until a later time, commonly when money is withdrawn. A registered retirement savings plan, or RRSP, is a familiar Canadian example. Contributions may be deductible, subject to available room and other rules. Growth inside the account is generally tax-deferred, but withdrawals are normally taxable. Deferral can leave more money invested and compounding during the accumulation period. A tax-free savings account, or TFSA, uses another model. Contributions are not deductible, but qualified growth and withdrawals are generally tax-free. Contribution room, unused room, and recontribution rules matter. The source also mentions the First Home Savings Account, or FHSA, which has its own conditions. Which account is better? It depends on current and expected future income, marginal tax rates, liquidity needs, workplace pension benefits, government benefits, home purchase goals, and available contribution room. An RRSP deduction in a high-income year can be valuable. In another situation, TFSA flexibility may matter more. Many people use more than one account type for different goals. The guide's long-term illustrations show why tax treatment can matter over decades. When taxes do not reduce growth every year, more capital remains to compound. But tax-deferred does not mean tax-free, and tax-free accounts still have rules.
A practical next step is to confirm your official contribution room, review current rules from a reliable government source, and consult a qualified tax professional before decisions that affect your return. Taxes are part of the return you keep.
It is natural to associate safety with an account that does not fluctuate. Liquidity and guaranteed deposits can be valuable, especially for emergency funds and short-term goals. But the guide asks us to expand the definition of safety. Safety is not only whether the number on a statement stays stable. It is also whether that money can buy what you need in the future. The source uses a simple illustration. $10,000 earns 1% interest for a year. At a hypothetical 25% tax rate, the interest is reduced after tax. If inflation is 3%, the purchasing power of the account falls, even though the displayed balance has increased. The lesson is not that cash is useless. Cash has an essential role. The lesson is that keeping every long-term dollar in a low-yield account can create a quiet risk. Future buying power erodes. Inflation affects households differently. A person spending heavily on rent, food, transportation, insurance, or healthcare may experience a different personal inflation rate from a headline average. That is why a budget and financial assumptions should be revisited regularly. The future cost of a goal may not be the same as it is today. The response is not to chase the highest possible return. Higher expected return usually involves greater uncertainty. Instead, match the purpose of money to an appropriate level of liquidity and risk. Keep emergency and near-term money accessible. Give long-term money a thoughtful, diversified opportunity to grow. Measure progress not only in dollars saved, but in the future life those dollars are likely to support. The guide uses a memorable phrase: become an owner, not a loaner. When you place money in a bank deposit account, you are effectively lending money to the institution in exchange for interest. That can be exactly right for money you need soon, or money that cannot tolerate loss. But for long-term goals, the guide argues that many people need some participation in the growth of businesses and the economy, rather than relying completely on interest paid by a bank. Ownership can take different forms. You may own individual stocks, exchange-traded funds, mutual funds, pension assets, or other investments that hold shares in businesses. When businesses grow, earn profits, pay dividends, or increase in value, owners may benefit. But ownership includes uncertainty. Markets can fall, businesses can perform poorly, and a positive result is never guaranteed in a specific year. This is why the guide connects ownership with time horizon and diversification. Money needed next year should not be treated like retirement capital. Money needed decades from now may have more ability to endure short-term volatility, but it still needs an allocation that fits your capacity for risk. Investment decisions should consider potential return, possible losses, need for cash, fees, taxes, and the ability to stay committed during difficult markets. The source's long-term return comparison makes one point visible. Modest differences in return can compound into large gaps over decades. But it also states that past performance does not guarantee future results. You cannot control market outcomes. You can control your saving rate, your diversification, your investment costs, your time horizon, and your behavior during volatility. Ownership is not all or nothing. You can hold both safe reserves and long-term growth assets. The question is whether your plan gives every dollar an appropriate role. Protect the money you need soon. Give money you can leave invested for the long run a thoughtful opportunity to participate in economic growth.
The guide closes its investing framework with 3 Ds: discipline, diversification, and dollar cost averaging. Together, they replace the impossible goal of perfectly predicting markets with a process that can be repeated in many conditions. First, discipline. Markets do not move in a straight line. Headlines, recession fears, elections, interest rate changes, and sudden declines can make doing nothing feel irresponsible. Yet repeatedly moving in and out of investments based on short-term news can turn volatility into permanent loss. Discipline does not mean ignoring information. It means remembering the purpose of the money, using an approach that fits that purpose, and resisting major decisions based only on emotion. Second, diversification. No company, sector, country, or asset class is guaranteed to lead forever. Diversification means spreading exposure across different holdings so that one disappointing area does not determine your entire outcome. It cannot eliminate losses or guarantee a profit, but it can reduce the damage caused by concentration. The appropriate mix depends on goals, time horizon, risk tolerance, and what you already own. Third, dollar cost averaging. This means investing a fixed amount at regular intervals, regardless of whether markets are rising or falling. When prices are lower, the same contribution buys more units. When prices are higher, it buys fewer. The source guide's example shows how an investor who continues contributing through a fluctuating market can accumulate more units than one who buys only while prices rise. This does not assure profit or prevent losses in a falling market. It does remove the pressure to guess the single best day to invest. The deeper lesson is behavioral. A systematic contribution plan turns market volatility from a source of paralysis into a normal condition of investing. You do not have to know next month's price. You need to know why you are investing, how much you can afford, and whether the plan still fits your long-term goals. Consistency is often more useful than confidence.
We have covered a connected system. Take control of decisions you can influence. Pay yourself first. Give your money different jobs. Make debt finite. Let time and compounding work for you. Protect the people who depend on you. Use tax rules intentionally. Remember that buying power matters. Give long-term money a chance to participate in growth. Use discipline, diversification, and regular contributions to stay focused when conditions change. The most useful next step is not to do everything at once. It is to create a 30-day action plan. In the first week, gather the facts: income, recurring bills, debts, interest rates, savings balances, insurance coverage, and the account types or contribution room that may apply to you. Do not judge the numbers yet. Just make them visible. In the second week, choose one automatic transfer that supports your most urgent goal. It may be a small emergency fund contribution, a high-interest debt payment, or a retirement contribution. If the amount is tiny, that is acceptable. You are building the process first. In the third week, identify one expense to reduce, cancel, renegotiate, or postpone. Direct that amount toward your selected goal. The guide's core insight is not that sacrifice is enjoyable. It is that intentional trade-offs create more options later. In the fourth week, schedule a review. Confirm transfers happened, check that debt payments are on track, note changes in income or expenses, update the goal date if needed. Then, repeat next month. Over time, increase contributions, reassess insurance needs, refine your investment approach, and seek professional guidance for decisions requiring deeper analysis. Financial security is rarely built by one extraordinary act. It is built by making a plan visible, making good choices automatic, and returning to the plan after every interruption. Begin where you are. Use the resources you have.
Take one meaningful action today. The future is not fully controllable, but your next decision is.